Who knew finance could be so much fun? Well, let's continue. We've been talking about risks and financial risks. Let's take a look at the term operating leverage. We finished last time talking about break-even analysis and the risk of the fixed cost versus the variable cost. We're going to call that our operating leverage. It's really an indicator of risk, the amount of risk that we're taking. The higher the variable costs, the higher the fixed cost relative to variable cost, the higher the risk that we're taking. And we can estimate that in terms of our break-even analysis. We did this problem last time. We found out that it's a little bit different. This one is $5 and $1. Let's work that one again, just because we got the time. All right, so what are our fixed costs? We rent the space for $200 and a t-shirt making machine for $200. Those are our fixed costs. So we have $400 in fixed costs. What can we sell these suckers for? We're still oh so clever, so let's sell them for $20 minus our unit variable costs. $5 for each t-shirt, plus another $1 to put the message on our shirt, minus $6. You can figure. Okay, minus 6. Who made up this problem? Should be able to do these things in your head. Now I'm going to have to use a calculator or something. So I get $400 fixed costs. Every time we sell a t-shirt, I'm making $14. Okay, so what does that turn out to be in terms of units? Turns out to be 28 and change. So we're going to say, all right, we have to sell 29 shirts to break even. Our operating leverage. The smaller this number to break even, the lesser leverage. The more we have to sell, the greater our leverage. All right, well, let's take a look at financing from the firm's point of view now. When we're talking about firm financing, we're talking about operating financing. Now we're talking about the firm as a whole. We're looking at the right-hand side of the balance sheet. When we look at the financial structure, the whole right-hand side. We want to look at basically liabilities versus equity. If we're looking at what we call just the capital structure, now we're just looking at stocks and bonds. We do not consider accounts payable and accrued expenses as part of the capital structure. We don't really consider those things as part of our financing. Yeah, they may appear on the balance sheet, but they're not really the financing of the business. All right, so we had operating leverage. Now we have financial leverage. The more we use bonds and preferred stocks, the greater our financial leverage. We're going to use fixed income securities to fund activities. Why? Because using bonds magnifies the effects on return on equity and earnings per share. Why does it do that? Well, because I have less equity in the business. I have less equity because I'm borrowing money, but I'm still making the same amount of profits. When we talk about leverage, we talk about using other people's money to make us money. We talked about that earlier in the semester when we were talking about ratios and things, right? So leverage magnifies our return for each investor, for the investors, and the return on each share of stock, because we're using other people's money, not stockholders' money, right, to make those profits. So what's the downside of that? I think we've talked about this before too. The downside is, yep, we can keep borrowing money and keep making these numbers go up and up and up for the owners. Problem is, when the market or the company starts going down, then this stuff gets magnified in the other direction. We lose big time the other way. So it's great going up, but it's great bad coming down. This is, I think I've said, leverage is like crack the finance. Yep, it looks great coming up, but you really crash when you're coming down. Not that I would know. All right, capital structure. How do you decide how much you should borrow? Well, there's a hypothesis, there's all kinds of theories, that the capital structure doesn't affect the cost of capital. How much you borrow versus how much you in bonds versus stock. Well, we kind of know that it does. We calculated, we saw that there's a difference both in terms of the cost to flotation cost, the amount we receive, and taxes and things like that. So there is a difference. Also for things like retained earnings. The independence hypothesis says capital structure does not affect the firm's value. Well, maybe. But what is a firm worth? Whatever somebody's willing to pay. And the more you borrow, the bigger the risk, and maybe people aren't willing to take that risk. So there's that hypothesis, but I wouldn't put a whole lot of stock in it. It's more to think about. Now, remember, some things, interest is tax deductible, and firms can default. So this is a good chart to look at. It kind of gives you the idea of how much you should borrow. Well, look at the cost of capital first for bonds. It stays very low, but at some point, it is very low, right? But at some point, it starts to go up. Why does it start to go up? Well, it starts to go up because you're taking on more risk. As the company starts getting up, this is the degree of leverage, the amount of debt we're taking on. So we take on debt, yeah, okay, that's the cost of capital for the debt stays the same. But as we take on more debt, at some point, it starts to rise. We become junk bonds. It's become risky. So that's the cost of debt. Let's look at the cost of common stock, or cost of equity. Well, the cost of equity is higher. And as we take out leverage, the cost is going to go up of that equity. People are going to want higher returns. So the cost is going to go up the more we become levered. Well, to get the weighted average cost of capital, we talked about that. We take the percent of debt and times the amount of debt, and the percent, or the cost of capital of debt, and we take the percent of equity times the cost of equity. We add those two numbers together, and if there's no equity, then it's just, if there's no debt, it's increasing debt. If there's no debt, then our cost of capital, weighted average, is all just cost of the equity. As we add more and more of this low-cost debt, our weighted average comes down. But at some point now, this is going to turn back up because the cost of debt's getting bigger, and so our weighted average goes up. At this point here, where our weighted average goes up, we call that our debt capacity, right there. That's the maximum amount of debt and have the lowest cost of capital. So we can keep adding, but at some point, because of the risk we're taking, our cost of capital will increase, and our weighted average cost of capital will increase, and there's where we should stop our leverage. Now there's some practical matters when you're looking at your capital structure. You want it to be in a reasonable range. Right? And there's kind of rules of thumb. Target leverage ratio ought to be around 2. Right? You don't want too much risk. On the other hand, if too small, then you're not really using other people's money. So a good target is around 2. That means a target of 2 means you have a debt ratio of around half. Half of your assets were bought with borrowed money. Coverage ratio. This is another ratio we haven't covered. Oops, no pun intended. Before. It shows, can you pay off your debts? And the ratio we use for that is something called times interest earned. Times interest earned. See, I'm going a little nuts now that I learned how to use this little red marker. Is our income that we're making divided by our interest expense. This is how much we have to pay in interest every period. This is how much money we've got to help pay that interest. And we want a lot more money than we have to pay interest. And you want that number to be greater than maybe 2.5. Why? Well, out of your operating income, you don't just pay interest. You got to pay depreciation. You got to pay, depending upon how you calculate. Some people put depreciation ahead of operating income, but you got to pay taxes and you want to make profits. So this number should be bigger than that number. In any event, look at industry averages. What are the other businesses doing? What are the good businesses doing? What are the bad businesses? And you try and compare. A really good rule of thumb, I think, to pay attention to is this. What you want to do is you want to match the borrowing maturity with the term that you're going to hold the assets. In other words, look at this one. Buy long-term assets with long-term liabilities or equity. If you're going to get short-term stuff, inventory, then use short-term liabilities. If I'm buying a house or a building or a tractor, don't use short-term liabilities. Use long-term. Why? You want to match the terms because these can be, the short-term liabilities can be more volatile. So you want to have certainty in your planning. This is a very important concept in terms of capital structure. All right. Hope that helped.